Three of the most popular ETFs in Australia: VAS, VGS, and DHHF. If you've watched any beginner investing content, you've heard these tickers 100 times. But here's what nobody tells you. One of them is quietly costing some investors thousands of dollars a year they don't even know that they're giving up. And it's not the one most people pick. By the end of this video, you'll know exactly which of the three fits your personal situation. Not a generic "it depends" answer, a real answer. Let's get into it. As a quick setup, I want to let you know that every number in this video comes from the official Vanguard and Beta shares fact sheets dated 31st of March 2026. We're going to be looking at four things: real performance over multiple time periods, what each fund actually owns, some hidden taxes you may be unaware of, and then a clear verdict for four different types of investors. Because there's no universal winner here. Anyone who tells you just buy this one is probably trying to sell you something. First ETF is the Vanguard Australian Shares Index. It tracks the ASX 300, so you're getting basically the entire Australian share market in one ticker. 311 holdings, a management fee of 0.07%, which is dirt cheap. But here's the thing that nobody mentions. The top 10 holdings make up 47% of the fund. That's the Commonwealth Bank of Australia, BHP, Westpac, NAB, ANZ, Wesfarmers, Macquarie, CSL, Woodside, and Rio Tinto. Four of those are banks. Australia is a bank and miners economy, and VAS reflects that whether you like it or not. It was launched in May 2009, so we have proper long-term data to go off. The second ETF that we're going to be looking at is the Vanguard MSCI International Shares Index. This is the developed markets globally, which excludes Australia. There's 1,275 holdings spread across 23 countries. The top 10 makes up about 27% of the fund, which is much less concentrated than VAS. But, and this is important, 72% of VGS is US stocks: Apple, Microsoft, Nvidia, Alphabet, Amazon, the usual suspects. It has a management fee of 0.18%, and it was launched in November 2014. The final one we're going to be looking at is the Beta Shares Diversified All Growth ETF. This one's different. It's a fund of funds. You buy DHHF and it gives you exposure to around 8,000 individual stocks across Australia, the US, developed international, and emerging markets. The split is roughly 36% Australian, 41% American, 17% other developed countries, 6% emerging markets. It is 100% growth assets, meaning there's no bonds. There's a fee of 0.19%. And here's the first thing that matters: the 10-year comparison. So let's talk about it. DHHF does not have 10 years of history. The current investment strategy only started in December 2020, so it's been running for around 5.5 years. When someone shows you a DHHF 10-year backtest, they're not showing you DHHF's actual returns. They're showing you a simulated portfolio of the underlying ETFs, which is not the same thing, so it's rather misleading. Here are the real numbers, fund by fund, with the periods we can compare. As you can see, over the last 1 year, VAS has returned 11.6%, VGS has returned 8.2%, and DHHF returned 10.7%. And then over the 3 years annualized, VAS has returned 9.4%, VGS a massive 16.1%, DHHF 13.1%. And then finally, over 5 years annualized, VAS has returned 8.5%, VGS 12.8%, and DHHF 10.2%. VAS is the only one with a 10-year track record, being 9.35% annualized over the last decade. VGS, which has 11 years of history, has done 13.26% annualized over 10 years. What this tells us is simple. International markets, mostly being the US, have absolutely smashed Australian stocks over the last 5 years. VGS dominated VAS, and DHHF, because it holds both, landed in the middle. That is literally the entire story of diversification. You don't pick the best performer in hindsight. You hold both and capture whichever one wins. However, I need to be clear that the last 5 years are not the next 5 years. Australian stocks underperformed because they're heavy in banks and resources, and tech stocks are currently leading the world. Whether that flips depends on AI, China, and a dozen other things nobody can predict. So performance is not the main reason to pick one of these. So, what matters more than the past returns is what each fund owns going forward. VAS is dangerously concentrated. Commonwealth Bank of Australia alone is around 11% of the fund. The four big banks combined are roughly 22%. You add BHP and Rio, and you're about 30% in 6 stocks. If Australian banks have a tough decade due to possibly mortgage stress or regulatory changes, VAS will have a tough decade, and there's nowhere to hide. VGS, on the other hand, looks more diversified, with 1,275 holdings, but the concentration risk has just moved. The top 10 stocks are basically the Magnificent Seven, plus a few others, and they make up about 27% of the fund. Information technology alone is 26% of VGS. If you already own one of these companies in your superannuation, and almost every Australian super fund does hold them, you might be doubling up without realizing it. And then DHHF, because it spreads across 8,000 stocks via multiple underlying ETFs, has the lowest single stock concentration risk of any of the three. However, the trade-off is that you can't tune it. You're locked into beta shares allocation. If you think 36% Australian is too much, or 6% emerging markets is too little, you can't change it without selling the whole thing. Now, we're going to move on to the more hidden things that you may be unaware of. First being franking credits. This is where it gets serious. VAS pays distributions that are about 80% franked. For a low-income investor or a retiree in the pension phase, those franking credits can add 1 to 1.5% in extra return that's basically invisible on the fact sheets. VGS, because it holds international shares, has zero franking. DHHF has partial franking on its Australian slice. If you're in the high tax bracket, franking matters less. If you're not, it matters a lot. The next important thing to realize is currency exposure. VGS is unhedged. That means when the Aussie dollar drops, your VGS goes up in AUD terms, even if US stocks did nothing. When the AUD rises, you lose value. Over a decade, currency moves can swing returns by 2% a year either way. DHHF has the same unhedged exposure on its international portion. VAS has zero currency risk because it's all Aussie companies in the Australian dollar. Next is fee drag over time. Fees feel small when you see 0.19%, but they don't feel small when you compound them. Let's take $100,000 invested for 30 years at 8% growth before fees. The difference between VAS at 0.07% and DHHF as 0.19% works out to be about $32,000 over that period. The simpler the fund, the cheaper it tends to be. So, for my final verdict, there are 4 types of investors and they need different answers. For the first type of investor, you're a beginner with under $10,000 to invest and you want one ticker, a set and forget. Therefore, DHHF wins. You're buying one fund, getting global exposure, automatic rebalancing, and you never have to think about it. Yes, it's slightly more expensive, but the simplicity is definitely worth it. For the second type of investor, you're in your 20s or 30s accumulating, and you understand asset allocation. VGS as a core holding is the better choice. There's a higher growth potential, a lower single country concentration than VAS, and you get exposure to where the actual innovation is happening. Add a small slice of VAS for the franking, and you've built a better portfolio than DHHF, often for a lower blended fee. For my third type of investor, you're a retiree or a near retiree in or approaching the pension phase. DAS becomes powerful. Why? Because franking credits get refunded as cash if you're in a low or zero tax bracket. That's free money the international funds can't give you. The income stream is the point at that stage of life. For the fourth type of investor, you're a high-income accumulator who wants control. DHHF is definitely the wrong pick. You're paying 0.19% for a portfolio you could build yourself for about 0.10% blended using VAS, VGS, and maybe a small slice of an emerging markets ETF like VAE or VGE. Plus, most high-income Australians already have heavy Australian property and super exposure, so DHHF's 36% Australian allocation is way too much. So, the answer to which ETF wins over 10 years is this. VGS had won in the last 10 years, but that's the wrong question to be starting with. Pick the fund that matches your tax situation, your time horizon, and what you already own, not the ones with the prettiest backtest. So there you go, that's my breakdown. If this helped, hit subscribe. As a standard disclaimer, I have to say this is general education, not personal financial advice. I'm not a licensed financial advisor. Before you put real money into any of these, speak to one or do your own research. ASIC's Money Smart website at moneysmart.gov.au is free and genuinely useful if you want to learn more.